and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based out of our Manchester office. And this week, I'm pleased to be joined by regular commentator and our head of fixed interest research, Richard Carter, and joined by one of our equity research analysts, Matt Dorset, who is responsible for coverage of a number of different subsectors, but of importance to our conversation today, aerospace and defence and transport. So the conflict in the Middle East continues to rumble on, with significant escalation towards the middle of last week, which saw a tit-for-tat strikes from both parties on energy infrastructure. So the South Pass gas field, which is the world's largest natural gas field, an ownership share between Qatar and Iran, was hit. So Trump quickly distanced himself, with Iran then retaliating on strikes on the Qatari side, sending both oil and gas prices spiraling higher. Qatar Energy confirmed the strike has wiped out 17% of Qatar's LNG capacity for around 3 to 5 years. So on the back of that, Netanyahu attempted to sue the markets and saying that Tehran's ability to enrich uranium and produce ballistic missiles was diminished. And whilst he wasn't putting a stopwatch on it, this war was ending faster than people think. And then over the weekend, we've had Trump then threaten Iran with further attacks on key energy infrastructure if the Strait of Hormuz wasn't open within 48 hours. Iran, as you'd expect, has since said it would then respond with targeted strikes on vital infrastructure across the region. So during last week, we also saw the resignation of the director of US National Counterterrorism, Joe Kent, in his resignation letter, stating his disagreement with the administration's involvement and the influence of Iran in decision-making. Following the resignation, we actually had House Speaker Mike Johnson confirm that he didn't know where Joe Kent was getting his information, and Trump stated that he always thought he was weak on security. So quite concerning, considering he was director of counterintelligence. Back to bonds. Short-term inflation expectations in the UK and Eurozone have continued to move higher. So now above 5%. For context, they started the year at around 3%. And then short-dated bonds sold off, having fallen steadily throughout January and February. The 10-year yield in the UK is now back above 5%. So unwelcome news for the Chancellor, and gold actually giving up all of its gains in 2026. We had a number of key central banks deliver rates as well last week, which we'll come on to talk about. So Richard, firstly, geopolitics. We did start with some stabilisation in markets and a bit of a recovery in equities. One of the things we've been monitoring internally is the disruption to the energy markets and how long that lasts for, and then the escalation that might happen on energy infrastructure. Given what's unfolded over the last week, what are your thoughts? Did it change your view on the impact on inflation and economic growth?
Yeah, it's worrying, Jack, because we kind of thought by now that maybe the conflict would be over, and we get these sort of mixed messages from Trump, don't we? Sometimes he's suggesting things are going to be winding down, and we've grown a little bit used to the whole taco thing, that when markets start selling off, the US administration changes course pretty quickly. But that hasn't happened this time, and we've seen, as you said, these attacks on energy infrastructure in the region, and we have the sort of Trump deadline to open the Straits of Hormuz, or the US is going to start hitting power plants in Iran. And inevitably, despite Trump's talk of having destroyed their military, they're going to fire back at various assets in the region, and the whole thing is, I'm afraid, showing no signs of de-escalation. So yes, longer it goes on, the worse it's going to be for inflation and growth. We are starting to see economic forecasters sort of downgrading their hopes for growth this year. It's relatively material. It's sort of 0.5% of GDP growth in Europe this year, a bit less in the UK. And they're also upgrading their inflation forecast. So we're not talking, 2022 levels or anything like that. But CPI in the UK is surely going to start going up, over the next sort of weeks and months, as long as this carries on. So it is a concern, and we just hope at some point cooler heads prevail.
Yeah, I think it was The Economist that said Trump, despite saying 100% of Iran's military capability has been destroyed, so 0% is still causing havoc in markets. So we'll see how that unfolds. So what did you make, coming back to the central banks, what do you make of the rate decisions that were delivered last week? We weren't really expecting any changes given these are relatively recent events, but we were kind of 4 weeks ago completely pricing out any kind of rate rises and rate cuts were still definitely on the cards. We then had the Bank of England, for example, they voted unanimously for the first time in quite some time on the MPC to keep rates on hold. And we've moved this morning, I think, pricing in 4 quarter point rate rises this year. So what are your thoughts on all of that? Are we kind of getting ahead of ourselves?
Potentially. I mean, I was not really surprised, obviously, last week that all the central banks just remain on hold. I mean, at the moment, that's probably the best thing to do. I was a little bit surprised about the reaction to the Bank of England meeting, because going into it, some people were expecting a couple of NBC members to vote for rate cuts, and I just thought, I can't imagine walking into a meeting at the moment, no matter how dovish you are, and sort of seeing what the oil price is doing. So I think we need an interest rate cut now. It just seemed to me completely impossible. So there seemed to be a bit of an overreaction to how the sort of 9-0 vote on hold was sort of taken. So it was a bit odd for me, but and sort of Andrew Bailey's comments on their policy were a bit more sort of nuanced. And I think most central banks are going to be on hold for now. But if in 6 weeks' time or beyond, inflation starts to spiking up and the oil price is still above $100 a barrel, they may need to start raising interest rates. It does seem a bit of a strange way to deal with the closure of Straits of Hormuz, is to sort of cause even more economic damage than there already is. But they're very mindful, I think, of what did happen a few years ago when they let inflation get out of hand and they were too slow to raise interest rates. We are at a better starting point now, though. Inflation pressures aren't going into this weren't as bad as they were coming out of COVID, and also interest rates are sort of relatively higher now. So hopefully they won't need to be raising interest rates by 1%, because if they do, the economic damage alongside the damage done by the conflict is just going to be very concerning.
Yeah, agreed. I think there are some similarities, but I think the inflation dynamic's probably a bit different this time around. Sticking with fixed interest, what's working in bonds right now? Because as we saw in 2022, they're not necessarily great in an inflationary / potential recessionary environment. What are index-linked bonds doing? Are they providing that protection? And maybe the short end of the curve now looks more appealing than it did perhaps a month or so ago?
Yeah, I mean, look, this is not, this sort of environment, spiking oil prices and rise in rate, sort of increasing inflation expectations is bad for bonds pretty much across the board. The shorter duration you are, the more cash-like, generally, the better you have done. Although that said, there's been a very, very sharp rise in short-dated bond yields, as you said, and actually less of a rise in longer-dated yields. But given the sort of interest rate sensitivity and sort of duration of those longer assets, it's been a difficult ride for investors for the last couple of weeks or so. Index-linked have held up relatively better than corporate bonds and conventional gilt, but they are a very long duration asset. But the shorter dated linkers have sort of done relatively okay. In terms of the short dated gilt, you have seen the yields rise pretty dramatically. Fortunately, their sort of interest rate sensitivity is very low, so the sort of price impact has been fairly modest, although, as I say, it would be more significant sell-off than just holding cash. But those yields have really got, I think, to pretty compelling levels. I mean, even if interest rates continue to go up, you're still locking in levels now that, compared to where we were a few weeks ago, I think look pretty attractive. So you're getting, almost sort of 4 70, 460, 470 on some of these sort of 1 to 2 year gilts, which I think if, when this all conflict does settle down, will look to have been a pretty good entry point, I think.
Yeah, agreed. Thanks for that, Richard. Much appreciated. Matt, turning to you now. Thanks for taking the time to join us. As I mentioned at the start, one subsector of your coverage, which does benefit from the ongoing conflict, is defence. We've already seen a huge re-rating of that sector over the past few years, spurred by, as we know, Russia's invasion of Ukraine and the increased defence spending across NATO members. We've touched on the traditional defence questions before, so I don't want to go over all old ground. However, one thing that we have seen with the Russia-Ukraine conflict, and more recently in the Middle East, is the rise of kind of drones and missiles, which have fundamentally changed how modern warfare is fought. And it's far more costly, as we've seen as well, to use a multi-million-dollar missile to shoot down a relatively cheap Iranian drone, which what Gulf members are experiencing. So, Matt, my question to you, what are defence companies doing to develop new ways to improve that cost ratio for intercepting cheap threats? Are there new companies out there raising money to develop these kind of anti-drone missile systems, which are significantly more cost-effective, or are the kind of incumbents doing that too?
Yeah, thanks, Jack. It's a great question and definitely one of the more contemporary areas of my coverage. And as you say, the methods and the economics of war have evolved significantly over the last few years. So I'll try to touch on all of that and maybe start with some of the defense primes and then talk a bit about the startups as well. So I think it's certainly true that the complex long-range missile defense systems aren't a sustainable or economical way to combat the threat from cheap drones. But as investors, we certainly shouldn't look past the opportunity from these long-range missiles. So the US, Ukraine, the Gulf are consuming a huge amount of missiles, and systems like the Patriot, the SAMP-T remain really vital for air defense. And these are incredibly complex, expensive products with huge order backlogs. So I think if you order a Patriot system today, you won't receive it until the 2030s at the earliest. So the real gating factor here is the productive capacity. Interestingly, Trump met the execs of some of the largest defense primes a couple of weeks ago and apparently agreed that exquisite weaponry, by which we would infer missiles, production should be quadrupled or will be quadrupled. So I think that side of things will remain a strong growth driver for companies with exposure here. But as you say, there's a large number of more nascent counter-drone systems being developed to better deal with the spectrum of airborne threats being faced today. Now, these counter-drone systems are quite complex. They rely on the integration of a system of systems linking sensors and software and effectors and integration with other air defense networks. So they typically are being more provided by the large defense companies with wider exposures, more experience. This spans systems including electronic warfare to jam drones, small arms, short-range missiles, interceptor drones to hunt down enemy drones and destroy them. So something Ukraine are very proficient at. Laser technology as well, which is under development. So Dragonfire is an example produced by MBDA, Leonardo, and Kinetic. Each of these capabilities come with their own strengths and weaknesses and cost variations. So I think what's vital is that air defense systems are multi-layered to deal with the breadth of different threats faced. And that's been very well demonstrated by Ukraine. So I think in our view, there's room for strong orders and growth across these products. And certainly that's what we're seeing at the moment. If I then pivot a bit to some of the newer startup companies, I think the observation I'd make from the outset here is that they're more focused on offensive drone capabilities rather than counter drone capabilities. Not black and white, but that's more of the generalization to make. And I think it's fair to say government procurement and defense primes have been slow to react to changing warfare and the growing importance of low-cost, high-volume offensive drone capabilities. And we've seen startups such as Helsing and Stark Defense and Anduril emerging to try and plug this gap. These companies have been very successful in raising funds. So Helsing raised 600 million euros last year at a 12 billion valuation. Stark Defence, I think, raised about 100 million euros last year at a valuation above 1 billion. But these companies aren't just raising funding, they're also winning orders. So we've had contracts worth hundreds of millions of euros from Germany for both Stark Defence and Helsing for their loitering munitions, which are essentially attack drones that offer cheap, precise, and dynamic attack capability.
That is really interesting, Matt. I guess to see how warfare's changing. And then on the flip side, the sector that's negatively impacted in your coverage is transport. We've seen an effective embargo in and around the Strait, and container ships previously using the Red Sea now having to divert around the Cape of Good Hope. So could you give us a sense of how much longer that takes, maybe how much more expensive it is? And maybe if you've spoken to some of the companies under your coverage, what are they saying in terms of the impact on their businesses? And if you can, the knock-on effect on the container ships reportedly trapped in the Gulf if they can't pass through the Strait?
Yeah, absolutely. So I think the Straits of Hormuz aren't as important for ocean freight. So before the war started, I think about 3% of container trade was passing through the Straits. The Red Sea is much more significant. Before the disruption that started there a few years ago, more than 20% of container traffic was going through the Suez Canal. We had seen transits through Suez starting to pick up a bit in recent months, still much below historic levels. But clearly, any restoration of that route is now going to be postponed for some time. And as you say, if you can't go through the Red Sea, you're going around the Cape of Good Hope. On average, that adds about 10 to 15 days to the journey for that diversion. So if you think about a sort of typical Asia to Europe trip, that could add about 50% or so to the journey time, and therefore following that through to the costs. This also effectively reduces shipping capacity. So that's putting upward pressure on freight rates. When I last checked, freight rates had risen about 35% versus pre the Iran war. And this is being exacerbated by other costs as well. So bunker costs, which is the cost of fuel to power the ships, have increased by about 90% versus Q4 25. There's also an issue of fuel availability at different ports, which needs to be managed. Insurance costs have risen a lot, and shippers like Maersk are announcing war risk surcharges of thousands of dollars per container. So it's a perfect storm for customers. The implications for the shipping companies themselves is more mixed. They tend to be able to pass these costs on very effectively through surcharge mechanisms while capturing a higher freight rate. So Maersk, as an example, which is a large shipper, the equity's performed pretty well since the war began. Likewise, the freight forwarders, so companies like DSV, tend to be able to pass these costs on fairly well. And while lower volume is a negative for those businesses, increased complexity is a potential benefit if they provide more value add for their customers. It's therefore the customers themselves that are bearing these higher costs. They also face less reliable shipments and severe disruption in the Gulf region, with ocean carriers effectively no longer accepting new bookings to or from the Gulf. You mentioned the ships that are trapped in the Gulf. That's another factor as well. So I think there are about 130 container ships inside or waiting outside the Gulf. That equates to about 1.5% of global container capacity. So by no means insignificant. And that provides an additional headwind to capacity and therefore more upward pressure on the freight rates as well.
That's really interesting context, Matt. So something, again, to keep an eye on. You mentioned it just, insurance. I know it's not strictly your sector coverage, but you alluded to that companies have commented on the impact of rising insurance. So I think a recent FT article quoted underwriters in London were quoting cover at 3 to 7% of a vessel's value versus 0.5 before. And then Trump, ever the opportunist, has arranged for the International Development Finance Corporation to provide reinsurance along with naval escorts. So have you spoken to some companies or seen some comments from them? What kind of impact are insurance prices having?
Yeah, so yeah, as you say, I think Phil could give more color, but it's definitely the case that a number of insurance companies have reduced their coverage for shipments in the Gulf or removed coverage altogether. My understanding is you can still get cover, but as you say, it's far more expensive. And it's on much more of a sort of case-by-case, single voyage basis. But for most of the shipping companies that I interact with, they've suspended any transits in the region until it's deemed to be safe for ships, safe for crews. So even if insurance is available, most of the container freight shipping companies are unlikely to use these routes anyway. Beyond that, though, insurance and other costs have risen more generally, even on different routes. The shippers are able to effectively pass this on through surcharges, so they're a little bit more insulated. Where possible, the logistics companies are trying to find workarounds in the Gulf region. So they're looking at alternative routing, storage in transits. But for some shipments that can't be transported to the originally intended ports, they're instead being diverted to the nearest safe ports, where customers then essentially need to decide what to do with their cargo. So do they want to take delivery here at that port, or do they want to transport it by another means, or change the destination altogether? So it's certainly a difficult time for customers trying to make those decisions. And I think the bottom line is the shipping companies aren't going to start using these routes until they feel confident that it's safe to do so.
Yeah, that makes complete sense. A very complicated situation. Thanks, Matt, and thank you to Richard and to all of you for listening. So did you enjoy the discussion on our podcast today? We love to hear from our listeners, so please review the show now wherever you're listening and share it on our socials and tag us at Quilter Cheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. In the meantime, you can head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can stay up to date with all of our thoughts on market news, industry insights, and our upcoming events and webinars on our website or on our social media pages. And finally, we do like to hear from our listeners. So if you've got a question that you really want to ask one of our experts for the next podcast, simply ask them via the weekly comments page on our website. But that's it for today. So thank you to Richard and to Matt for your time, and to all of you for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.